Okay, well, let's welcome in Vikash Prasad. He's a portfolio manager, Asian equities at MNG Investments. Vikash, great to have you with us here. Good morning, Prashant this side. Just a quick sense on those sound bites. Did we hear anything new? He was not going to say anything, how do I put it? He's not going to respond to anything political in that sense with all the berating he's received from President Trump. And he kind of sort of stayed the path. He said, well, no rush to cut rates. We'll watch inflation closely. I mean, the same things any Fed chair will say. What did he make of it?
Good morning. It's wonderful to be back after so many years. I would say that I didn't hear anything new. It remains a tricky balance. But given our focus on Asia, what is encouraging is what we see on the ground here. And while the path of the US economy will always be important to the rest of the world, there are a lot of things here in the region, in India, in China, in Japan, that we see that make these countries and economies and markets more independent than they used to be. We're very constructive on Asia broadly. We might have been a little bit early a couple of years ago to assume that the divergence between the US and the rest of the world would converge at some point, led by Asia. But we're seeing that happen now, and we've figured that that will continue.
Vikas, hi. Good to have you on the show this morning. So within Asia, what we've seen, at least in the last 4 or 5 months, is that as money has started shifting or rotating from the US to an extent, it's gone to Europe. In Asia, I guess it's going to South Korea, maybe to China, I don't know. But India has not really got its share of the steady foreign flows in a while. What do you make of it? Do you see that changing?
Well, I would say broadly first, the markets in Asia have been remarkably resilient this year. If you go back to the sell-off, if we start in India, the sell-off that we saw in small mid-cap names in January, February, the volatility we saw around that Saturday when the budget was announced, and then we've had Liberation Day, armed conflict around the world, markets have been very resilient. And India led the way back post-Liberation Day. It was the first market to recover its losses post the first week of April. So I would say that India has been very resilient. I am glad that you mentioned South Korea because it's something that we've been thinking about. We will know soon about the developed market status of South Korea. If that happens, I don't see that is.
It's not happened because I'm happy to fill you in on this. Our colleagues were tracking this very closely. And no, they remain a developing market. They're not moving to developed categories. So we don't have any reason to rejoice, at least as of now, from an Indian perspective. Yeah.
Right. So maybe next year. But given the recovery that we've seen in South Korea, given the volatility we see around the tech industry still in Taiwan and in South Korea, some of those fund flows should make their way back to India, given the strength of the domestic story. One stat I share is that less than 60% of the S&P 500 revenues are from within the US, whereas you have almost 75% of NSE 200 revenues coming from within India. And that number is only going higher. So this is a very domestic story. It's why this is an appealing story for long-term investors and for active managers alike.
Hi, Vikas. Good to see you in. Nigel on this side. You've mentioned that you've allocated a little bit more to India, and you're saying that India is a long-term opportunity. Though there are a couple of pockets which are expensive, tech and consumer staples, but there are still opportunities. Tell us with regard to the Indian markets, where are those opportunities you're finding?
But even though staples broadly and IT companies broadly have underperformed over the past few quarters, that does not make them inexpensive. That does not make them appealing for us. We remain more underweight these two sectors than we have been in many years. We still think that they're expensive given the earnings outlook. And we're not zero weight or underweight every name in these two sectors. And we own some off-benchmark exposure in both sectors also. But the earnings outlook is challenging. So not only in an absolute sense are they less appealing than they used to be, in a relative sense, relative to other opportunities, which we like, we have allocated less capital to those two sectors. So what do we do? What we do like healthcare services, whether it's CDMOs, diagnostics, hospitals, travel-related companies, hotels, airlines, OTAs. We like auto parts. That to us is an underappreciated sector of the economy, we think. There's a lot of noise around the headlines around tariffs and OEMs. But when you start looking into the quality of businesses that are listed in India in the auto parts space, we like those as well. High-end real estate, we like as well. So there's a lot to like. NBFCs has been a key overweight for us this year. We've reduced some exposure in about the last couple of weeks. Same with defense this week. Finally reduced some exposure after adding to it in February. But we remain overweight that sector as well.
Okay. Got that. Vikash, thanks very much for your thoughts and for your time today. Good talking to you, and hopefully we can do this more often in the weeks weeks and months ahead. Thanks very much for being with us.